Hi guys, let's move on to the next chapter, chapter number 4. But before I do chapter number 4, I would want to quickly recollect what we have done in the first three chapters. We've already covered two phases of strategic management, which is about, also we have known about introduction wherein we discuss about strategy, management, strategic management and all those basics. But then we covered phase 1 and phase 2 of strategic management. So before I begin with chapter 4, let me quickly take you back there for a minute so that we have a clear understanding. Phase 1 about the vision, mission, objectives and goals. Now I'm skipping that, going further detail because we have seen enough. And phase 2 also we've been seeing enough in the last few sessions wherein we've discussed strategic analysis. Now wherein the story breaks down to phase 3, which is going to be the key phase for us in this discussion and the ones upcoming. Phase 3 is called as crafting the strategy, which is again going to be broken down into three parts, which is about the corporate level strategies. Now, like how we had strategic analysis with three branches for the last few sessions, this one is going to be there for the next few sessions, which is crafting the strategy of that is of corporate level. Then we have business level, and then we also have functional level where we plan for the six different functions in the business. So at corporate level we have four strategies. What are those, and why are they called grand strategies? We will see that also little later. I will again explain you this in detail. At business level we have three strategies given by Michael Porter, so which I guess you already have an idea of because you've heard those words: cost leadership, differentiation, focus. We have seen those words, so we will discuss more about them as we go into that particular chapter. And the last part deals with all of what you call it as finance, marketing, HR, production, inventory management, and all of this. So these are all some of the functional strategies that we are going to discuss in the sixth chapter. So that is the order here, what we are going to discuss in the fourth chapter, fifth chapter, and the sixth chapter. So this entire aspect of crafting the strategy will be called as strategy formulation. And then this is followed up by phase 4 and phase 5, which is about implementation and evaluation, and then seeing if it requires us to take any corrective action. So this is where we are, and now what we will do is to go back to what is called as chapter 4 and discuss more from there. So moving on to chapter 4, which is about the corporate level strategies, and then I will take you to the very first part. Okay, so let's start at the beginning of the paragraph, which says uh, two people are involved here. One is William F. Glueck, who gave you the strategy definition back then. The other one is Lawrence or Josh, is somebody who is also along with William F. Glueck. So this is one of the reasons why these set of strategies are also known as Glueck and Josh strategies. Now going back to the beginning a bit here, we also call it as Glueck and Josh strategies. Then we also call these as corporate level strategies or top line strategies. Okay, so you can underline those two names if you want to. William F. Glueck and Lawrence R. Josh discussed four generic strategies, which are stability, growth, retrenchment, and combination. While Michael Porter, what did Michael Porter suggest? Michael Porter suggested competitive strategies, which include cost leadership, differentiation, focused cost leadership, and focused differentiation, which could be used by the corporates for different type of business units. Now, we will obviously see in detail, as I told you, both Michael Porter's strategies and functional strategies all are in the upcoming parts of our story. We can classify different type of strategies on the basis of the levels of the organization, their stage of life cycle, and the competition as given below. So we've already had an oral discussion about the table. Now going by those three classifications in the table. What is the first one? Based on the level, we all very clearly know, very clearly highlighted: corporate level, business level, and functional level. Three levels of strategies. Now, once again, I would want to clarify that in the product's life cycle, every firm will have to go through introduction, growth, maturity, and decline. And throughout all these four stages, we will not be able to continue with the same strategy. And that is one of the reasons why you see these four given separately here. At the entry or introduction stage, we might follow the market penetration strategy, because you are now introducing a new product. When you do existing to existing, you might want to go for a penetration strategy, no problem. In growth stage, what we are going to discuss in detail now is the growth or expansion strategy. We will see that. Then at maturity stage, maturity is a level which is, at number 3: introduction, growth, maturity. And when we go there, I will obviously show you. So because that's where we're going to start with stability strategy. And then decline, we have decline is a time where companies going through a tough phase because it's already reached maturity and it's going to constantly come down now. But you need some remarkable change to fight back and stay in the market. So if you decide to do that, or at least give it a try, then you might end up doing something which is called as a turnaround strategy. We will obviously see in detail as to what the turnaround strategy is. Then, based on the classification of competition, we have two kinds of categorizations there: what is called as competitive strategy and collaboration strategy. Now, as their name goes by, competitive strategies are where people fight it out for. Fight it out for in what way? They might fight it out in the name of cost, trying to be the cost leaders, that is, striving to produce at the lowest cost. Then we have differentiation, which is about just being unique when compared to the others, and focus. I think these three names have been introduced to you in the past, but then we didn't discuss them in detail because, as part of fifth chapter, we're going to discuss that story as the Michael Porter's three generic strategies. Now, sometimes when competition goes cutthroat, cutthroat competition means peak competition. What happens is some competitors, they decide to unite together to bring down the others. One of the recent and the best examples, as we discussed, is Idea and Vodafone. Now, when Jio stepped into the market, Jio started grabbing market share. Now, what happened with Airtel is it already had a huge customer base. So, Airtel's drop in customer base, no doubt, was there. But due to its terrific service, Airtel was able to, kind of regain or bring it back to normal kind of a situation. But both Idea and Vodafone, on an individual standpoint, they have a terrible times. So what did they think? That then, like, if we continue to do this individually, we both will collapse. So why not collaborate? Collaboration can be happening through a merger or acquisition, or collaboration can also happen through a joint venture for a fixed period of time or indefinitely, anything. So joint ventures, mergers, acquisitions, all these are some forms of, again, growth, but they are called collaborative strategies. Now what you need to know, slightly important here, is the other name for corporate level strategies. Corporate level strategies are also known as grand strategies. What are they known as? They are known as grand strategies. So I would like you to make a mention of that here in the clear terms, because that's something very important. We'll have a clear and detailed understanding of what those are. But corporate level strategies, okay, there you go, you will be able to see it now. Corporate level strategies are also termed as, corporate level strategies are also termed as what all? We can call corporate level strategies as Glueck and Josh, Glueck and Josh generic strategies. Top line strategies, when somebody says or talks about top line, it means they're talking about corporate level. And also these are called as grand strategies. The word grand is used here because of the scale involved in these strategies. So corporate level strategies have these names, which are um, in the likes of Glueck and Jaws, top line and grand strategies. So I just want you to keep these in mind. And later, if at all they ask you in exams by using, these kind of twisted names, do not get confused. Stay very focused. That's why I'm telling you. So make sure that you write down in one particular place and keep the names. Corporate level strategies, also known as grand strategies, are meant to provide direction to the company. That's obviously the futuristic idea, direction to the company to implement the corporate and business level strategies. Functional strategies are formulated in business areas. Functional strategies are formulated in business areas like production or operations, marketing, finance, HR, that we will discuss in detail in the sixth chapter, as I already told you so many times. Now, this is where I want you guys to take a quick look at the four strategies which are at the corporate level. We don't really have to bother about the content that is there in each box, because end of this chapter we will be able to fill that box by our own, because right now it's a one line summary of what will that strategy be. Maybe I think we should just take a read, that's all, not bother much about it, because we're going to deal in detail. Instability strategy, that is, you want to stay stable. Now please remember, stability means not finding one cozy corner and going and sleeping there. No, that's not what stability is. I'm going to elaborate that, but just understand, we do work, we continue to keep doing what you're doing, that's all. We are not doing anything new or additionally. We are not doing anything new or additionally. That doesn't mean, we found one cozy corner and we go off to sleep. That's not stability. Okay, many people have the wrong notion that stability means doing nothing, just fold your hands and sit. No, stability is about continuing to do what you're already doing. So the firm, what does it do? Stays with the current business. It stays with the current business and product, maintains the same market existing level, and it's satisfied with incremental growth. I hope all of you here are aware about what is incremental growth and radical growth. This is the third or fourth time we are encountering these words. Incremental is a phase wise, stepwise growth, while expansion, wherein we use a radical growth, where we want to see high growth. Firm seeks to see significant growth within the current businesses, maybe by entering new businesses that are either related or unrelated. That's a great thing. If you're entering into a new business which is related to your current business, okay, that is also diversification. But if you're entering into absolutely new areas which are not related to your business and you're bringing those into your portfolio newly, that is also diversification, and we will see what words are being used for all of that. And as I told you, when things don't go in your favor, we've already seen in the BCG matrix, we've already seen in the GE model, they've all suggested you to harvest or divest. So, see, harvesting or divesting is not a wrong thing in business. It's not like you're admitting defeat. I have to go and sit in one corner. No, not like that. Okay. See, what's the point in sticking on to a place where you know that you're going to continue to make losses? So the quicker you come out, the better, right? So that is why we have a strategy called retrench. But sir, do you think, should I give up so easily? No, if you don't want to give up so easily, then do one thing, which is called as a turnaround. So three retrenchment strategies are there. First of which is called turnaround. That is trying to revive things one last time. I think those of you who are PUBG players, you guys know what revive means, right? So that fellow is almost in the deathbed, like you go and give a revive. I mean, I don't want to kind of tell those examples, because there are a lot of people who don't play that. So but normally for those who play, I guess that's very easy to understand. That means almost in a dying situation and trying to revive, to bring back, that is called a turnaround strategy. I think for you guys, I'll give you another example, those who don't relate to that PUBG example. What I can tell you is the cricket example, where in the last few overs, when somebody wants to win, and the opponent, either the bowlers bowling team or batting team, there'll be one player who will come and do the damage, like coming and hitting sixes one after the other and taking away the game from the other. Or there's one bowler stepping in and charging in with wickets one after the other. So both ways, the commentators generally use a word like that was the turnaround in the match. So turnaround is a kind of a strategy where you are trying to bring back things to normal. That means it went out of your hands, you want to bring it back to normal. The firm retrenches some of its activities, cut down some of its activities, or maybe even want to drop the businesses through either selling a portion. If you want to sell only a portion of your business, it's called divestment. But when you want to sell the entire business, pack up everything and go where? Maybe Himalayas, I don't know where. But that, if you want to sell the entire assets and discharge all your liabilities and say bye to it, then it's called liquidation. I hope you guys will be more aware than what than me what liquidation is, because you will also end up doing a chapter called Liquidator's Final Statement, which is again an aspect of the Companies Act called as winding up. So you guys might better know liquidation as the term winding up. It's used in Companies Act. If you have done it, very good. If you have not yet done it, you will soon encounter it. So nothing to worry on that. And as we know, for a multi-product business which is having multiple number of businesses in its portfolio, some places it might seek stability, some places it might want to expand, and some places it might want to retrench, which is what is one of the fantastic strategies called combination. So many multi-product businesses, they might adopt a combination strategy. Entire organization, all 20 products have to grow. It's not a practical thing, right? And same way, all 20 products will be on the decline at the same time. No. So products which are on the decline, for them you can adopt a retrenchment strategy. Products which are new and which kind of wish to grow, you can adopt an expansion strategy. And mature products which have already reached the particular level, keep themselves there as long as they can go with a stability strategy. Doing all these three in some kind of a permutation and combination is only known as the combination strategy. The firm combines the above strategic alternatives in some permutation or combination so as to suit the specific requirements of the firm. So those are the four corporate level strategies which you are going to see in greater detail. Now, to start off with, we have what is called as a stability strategy. Let's see what stability strategy is. One of the important goals of a business enterprise is stability. Now, as the name goes by, why do you want the entity to be stable? Because, see, when you are already finished your maturity stage, for this, I would like to explain you with a little bit of understanding the product life cycle once again. So, I want you guys to concentrate a bit here. Let me take you through to the products life cycle so that understand that example and the cycle once again, so that it makes our life a lot more easier. Now we know that introduction, then growth happens, then the curve flattens out like at maturity, and then there is a decline phase, right? Okay, now at this stage, okay, so this is how we have all four stages. We already learnt as the prerequisite for portfolio analysis, but we didn't use it much there. Now this is the intro stage, wherein we by ourselves don't know much about what product we have and all, we have to experience it. But once all these are settled out, where people are happy with your product, that's when your product finds acceptability. That will be the golden days for you, which will be the growth phase. Now this growth curve can be longer wherever it is, but it will reach one point wherein that point is called as the point of saturation. People are like, okay, enough of this product now. What will they do? From tomorrow morning, everybody will stop buying? No. It will flatten out and slowly it will come to this way. So now this stage, the very critical stage called maturity, because people don't want your product, and at the same time some people still want your product. So you don't know whether the sales are declining or what's the futuristic trend and all. But this is the end of saturation. At the end of saturation, where decline begins, now this is where you got to take a call for organizations which are on the decline. Now let me tell you where each strategy comes in. It's very very important. Please concentrate on this piece very carefully. In the introduction stage, we will see what strategy we got talked to, but rather in the growth stage, without any doubt, we will follow the expansion strategy because it's a great phase. We'll expand and go. Now at this maturity stage, which is what it's critically being dealt at, you don't want to do anything new, you don't want to put fresh investments, at the same time you don't want to take any risk, just continue to do what you're doing. That is called as a stability strategy. Okay, now no doubt in the decline phase you will obviously follow the retrenchment strategy. Now you may obviously ask me, like, will we not have any strategy at the introduction stage? No, many times at introduction stage also we'll have a stability strategy. Why is that done? To prepare for a greater launch. Now have you seen a rocket launch? What will be there in a rocket launch? Everything will in the surrounding be absolutely quiet, very clear. You don't even know that the rocket is going to start off from there. But once everything is set up, once the ground is set up, everything, then the rocket takes off, and then immediately after it goes, you can't even see, it just moves out of your eyesight very quickly, because that's how it is. The same thing. So if you are well established till here, you won't even know how your growth will span up. So sometimes many companies adopt even the stability strategy at this beginning stage, so as to prepare it as a great stage for a future launch, which is not absolutely wrong. Okay, you can definitely try that. So stability strategy more often done at maturity stage, but it can be used at introduction stage also, nothing wrong. Okay, so this is something that I want all of you to be very clear with, because which stage what happens is a very very critical thing. Okay, so let me move on now to discussing what is given here for this particular strategy. One of the important goals of stability strategy is to safeguard its existing interest and strength, and to pursue well established and tested objectives. To continue in the chosen business path, we are not doing anything new. We're just going to continue in the chosen business path to maintain operational efficiency on a sustained basis. Not only that, if you have already got a commanding position, to consolidate the commanding position already reached. Many times you observe this kind of a strategy in football. 85 minutes, 86 minutes are done. Okay, the team which is playing at one end is 2-0 up on the game. Okay, now what do? Do you become aggressive and try to score the third goal and make it 3-0 and put more pressure on the opponent? Is that what you want to try? I don't think that will be a great strategy to do, because the other team is on 0 goals. Their entire effort is attacking effort. Now, in the name of you doing a counter attack, what if you miss your defense? So that's why you see these teams which are 2-0 up, 3-0 up, what they do in the last 5-6 minutes of the game, they simply keep passing the ball here and there. Okay, waste a lot of time, hit the ball outside, try to just while away time. Why do they do all this? Because you're already reached a commanding position. Just maintain whatever you're doing. And another 5 minutes are over, the hooter runs up, 3-0, you will win the game. But some people, when they even want to try and be aggressive. Now, I have myself seen so many matches which go haywire in the last 5 or 6 minutes, and I have seen teams which were 2-0 up in a football game of 90 minutes, who are 2-0 up till 85th minute, then they have lost the match 3-2 in the last 6 or 7 minutes, that is the 5 minutes left plus couple of minutes of injury time and this that. In those 7 or 8 minutes, the opponent have scored 3 goals. Sir, what nonsense are you talking? How is this possible? Now, those of you who watch football know this. I don't have to tell you a specific match. This is something that has happened so many times, right? And those of you who don't, you can just understand the fact that I'm trying to tell you here. You were in a commanding position at the 85th minute. Why did you try to attack? They are already in attacking mode because they are 0 goals. They want to score at least 1 goal first, and then try to score one more goal to equalize you. That is what they are trying. No. In their aggressive mode, you also are being aggressive. Your slighter mistake will give them advantage, which is what happens when people turn out to be greedy. 2-0 up, you are winning the game hands down, no problem. No, I want 3-0, I want to make a personal record, or I want to, like as a team, we will showcase something. See, if the opponent is a weak team, you are already 7-0, 8-0 up, then, like it goes, it's okay. But not when you are 2 goals up or 3 goals up, you should not do that. Because you've already reached the commanding position, shut your mouth for another 5 minutes. Play the game, go on. Stability strategy. Continue to do what you're doing. Don't charge in an attack now. It's not a great time to do that. That's the meaning. Okay. And also optimize the returns on resources already committed in the business. Stability strategy is pursued by a firm when, I think I told you this now only, but once again we will read it from the text given here. A stability strategy is pursued by a firm when it continues to serve in same or similar markets when it continues to serve in same or similar markets and deals in same products or services. So you have not done any alterations to your product portfolios, you have not done any drama, you have not changed anything. You are simply continuing to do what you do and where you do. You are in the same market or similar market and you just are producing the same products and services. And what you are inching for is an incremental improvement, not a radical improvement. The strategic decisions focus on incremental improvement of the functional performance. So you don't want any kind of a radical growth or overnight you want to zoom up. You don't have any ideas like that. You want to grow coolly and comfortably. It's a very good strategy. But many people, as I told you, will think stability strategy means folding hands and sleeping. No, stability strategy is not a do nothing strategy. So stability means do nothing, find one corner and sleep. Not like that. Why am I repeating it so many times? Because despite repeating it so many times, people still make the mistake. So which is why I'm telling you, stability is not a do nothing strategy. You need to understand at which stage of the life cycle you are and then take a simple call as to just continue to keep doing whatever we are and let's get an incremental improvement. It involves keeping track of new developments. It involves keeping track of new developments to ensure that strategy continues to make sense. Strategy continues to make sense. Stability strategy is followed by whom? It is typical for those firms whose products have reached maturity stage of the life cycle. Understood. Not only that, as I just told you some time back, some firms even do this as part of a great launch. So, for providing a great launch for that product, we also do it in the beginning stage. Small organizations may also follow stability strategy to consolidate their market position. That means understand and bring everything together. Okay, sir, we are planning for growth, but for growth, that is the launch that we have to give. Now, I'll tell you something very easy for you to remember. If you want to push something very far using a spring, what will you do? You'll not just press the spring and leave it, no. You will press it to the maximum so that the more you press it, the more force it exerts. I hope all of you know the basics that drive this. Same logic we are applying here. Before a rapid expansion theory, we're just stabilizing our business to an extent so that once we are stabilized and we know everything, then leave that spring, then it will shoot. Small organization may also follow stability strategy to consolidate their market position and prepare for the launch of growth strategies. Okay, so that's your very first corporate level strategy, which is chosen by the corporate level at a time where you are either in the maturity stage or you are in the pre-growth stage where you want to set a proper stage for the launch of growth strategies. Some of the characteristics of the stability strategy are, okay, I think all the characteristics are something that we orally finished off in our discussion. So please stay put and understand what each one of those. One, firm stays in the same business, same product, same market posture and functions, also maintaining the same level of efforts at present. So that means you're not downgrading yourself, not upgrading yourself, nothing. Stay stable, which means staying wherever you are. What is the effort, sir? What are we doing here? Staying wherever means the endeavor. Endeavor means effort. Those of you who don't know the word endeavor, please write down. Endeavor is nothing but the effort. The endeavor is to enhance functional efficiencies in an incremental way, step by step. The endeavor is to enhance functional efficiencies in an incremental way through better deployment. That is, deployment means putting into use. I think I made you write somewhere. But if you don't remember, please note it down once again. Deploy. Deploying resources means putting the resources into use. The endeavor is to enhance functional efficiencies in an incremental way through better deployment and utilization of resources. Of course. Sir, are we changing anything in business? No. Sir, are we bringing any fresh investment? Is there any new risk? Nothing. Whatever you are doing, you are just continuing that. In that, what risk is there? In that, why you need more money? Nothing. Very simple. Stability strategy does not involve a redefinition of business. It does not warrant fresh investments. Risk is also less. 3 points, remember. Okay? They always go hand in hand. Continue whatever you are doing. No redefinition of business. Stay wherever you are. Staying wherever you are a technical name is there for that called status quo. Maintaining a status quo means just maintain wherever you are. It is basically a safety oriented and status quo oriented strategy. It's basically what? A safety oriented and a status quo oriented strategy. It does not warrant much of a fresh investment. It involves only minor improvements in product and packing. Risk is absolutely less. Firm has the benefit of concentrating its resources, means deploying or putting in its resources and attention on existing businesses or products. So what is the benefit of doing a stability strategy? All your energy, all your resources, all your thoughts, you can focus on your existing product. You don't have to go outside the box and start thinking something new. In fact, sir, don't you think you should grow? I will, and I want to, but I will grow incrementally. Only those companies with that sort of an objective, that they will grow step by step, a modest growth objective, not a rapid growth objective. Tomorrow morning when I wake up, I should wake up in a golden, what do you say, place. It's not possible. You got to kind of wait for that and then build that golden palace and then wake up there. Okay, are you understanding the analogy? So the growth objective of this firm, sir, why are they doing stability strategy? Do they not have any objectives in their life to grow? They have. But like you read, they're preparing themselves for that growth. The growth objective of firms employing this strategy is quite modest. In fact, it's the other way around also works. Only those firms with modest growth objective will choose for stability strategy. If firm does not have modest growth objective, they want to rapidly grow, they will go to the next strategy. No, why will they stick on to this one? Got it? Then to sum up this topic of the first one, stability strategy. Why are we doing stability strategy? You all know the first reason. Major reason for doing stability strategy is obviously product has reached the maturity stage and there is nothing much to offer for that product anymore. Two, it is less risky. It is less risky as it involves less changes and the staff feel comfortable with things as they are, just as they are. Okay, that is what is the easy part, less risky. The environment is also relatively stable. If environment is not relatively stable, if environment is turbulent, it's changing. If environment is changing, you will fold your hands and say stability strategy. That will be too stupid. That time you also have to either be dynamic or proceed with caution or do something. But it requires a strategic response. You cannot do a stability strategy and keep waiting. My time will come. Okay, this is not apna time aayega story. This is something where you have to work. Okay, in this particular situation, if you wait for apna time aayega, things will not work. You have to get down into the situation, understand and work. Why? Because the market is relatively stable, and in a stable market, unless you get down and work, nothing will happen. Correct? So continue to do what you are doing, maintain your position. Market is relatively stable. No sir, turbulent environments have come, market's relatively unstable, or in fact I don't know what to do in future. Now, relatively stable, continue to do what you're doing. When it's unstable, is it a good time to grow or is it time to pull back money from the market? So you will think of new strategies like expansion, harvesting through retrenchment or whatever in a different. No sir, whatever we are doing is going very cool. Okay, relatively stable. Expansion may be perceived as being threatening. No, sir, now is not a right time for expansion. If you have a feeling that now is not a right time for expansion, then also you can go for stability. Reason number 4. Right now, doing expansion is dangerous. When you get that feeling, then continue to do stability. And fifth point is something that I want all of you to concentrate here. Consolidation is sought through stabilization after a period of rapid expansion. What comes after rapid expansion? Almost you are reaching maturity, early maturity. And when early maturity is coming, you won't try and do any new funny strategy. It's only going to fail. So, I mean, like this is the calm, not after the, not before the storm. This is kind of a calm after the storm. Many of the examples, they generally tell you that the situation will completely get calm and then a storm will come. I hope you guys have heard such examples. The calm before the storm. A huge storm is going to come and destroy everything, like something like a tsunami or something is going to come, but the environment completely silence off before that. And people, silence is also sometimes very scary. And most times silence only is scary. So when everything settles down like that and it's very cool, people start panicking. Okay, are we headed up for a big storm? What should we do? Now, what should we do? You should got to take precautions. Let's say it's beyond our control. What will happen? The storm will come, destroy everything. Now, you know how that situation is. At the time of the storm, there are heavy winds, rain, then everything, like post storm, what will happen? Again, everything will cool down. Again, the same silence continues. But most people don't talk about that silence because it's a post disaster scenario, is not a great scene. Everything is distort here and there. So that's why we don't make a fuss about that. But generally, when some rapid expansion happens in every business, you want to for sometimes sit and breathe. This is like running very fast for quite a good distance, and then you should like, okay, relax and take a breath, because if you continue to run in that speed, maybe you will lose all your energy and fall off. Then it's a little break for recharge. This is that. So after rapid expansion, take a small break, do stability for some time, then again prepare that stage for launch, and then from there again continue expansion. No, sir, but by the time we already reached maturity, continue to stay stable. Let maturity stage get over. When you fall to the decline stage, that's when you can think of doing a turnaround or giving up on that product. Now, that depends on time cycle. One thing that you have to remember is all of what I discussed with you now is not going to happen in 6 months. There is a phase. For something like this to happen, it might take 3 years, 5 years. I won't say 10 years now. Back then, I used to tell 10 years, but now 10 years is too a long time to be having a predictability. Because when a decade ago, I could have confidently told, for the next 10 years. Now I don't know. Now in 3 years, also is a big challenge. We don't know what next year will be. Last year, we never thought, things will be like this. A pandemic is like a once in a century example, and it set up so many things upright. Now, many people post pandemic, they have no option but to follow stability strategy, because post that rapid growth expansion not happening. So maybe slowly, step by step, at a coolant. But these kind of situations, are unpredictable. So those can't be benchmarked as regular examples. So what we do and what we understand about ourselves, and that is why we did so much of analysis back then in the second chapter. So for doing a stability strategy, for doing an expansion strategy, or in fact for doing any of these strategies, do we have the resources? Do we have the strengths? Or are we overburdened with weaknesses? All this you should do and then come here. Okay, so that's why you choose stability strategy for 5 reasons. Once again, when a product reaches maturity stage, it's less risky, so we go with it very comfortably. Environment is continuing to be relatively stable, so you can without any hesitation go with the stability strategy. Or when you think expansion is not a good option right now, then also you can go with stability strategy. And after a great expansion, when you want to take a breather and you want to like sit down for some time and breathe peacefully, okay, because when you run, what will happen? You start panting, right? You want to sit, take a nice breathe. That's when you will do stability. Okay. So that's our very first part of the discussion from the corporate level strategies. So going back to that piece of where we were, I would want to go and fill this now. So there is nothing much, and I will quickly once again show you what the scenario here is. So therein, so corporate level strategies, of which the first one is called as what? Stability strategy. Key points. What are the key points to take home? Very important. Stability is not a do nothing strategy. It's very important for you to understand this word, not a do nothing strategy. And generally done at maturity stage, or you can even use it for growth. Okay, normally no fresh investments, very less risk. Okay, and other characteristics. I hope this piece was very very easy to understand. The next corporate level strategy that comes up is a very very important strategy, which is called as the expansion strategy. Now what I want you to do before we discuss the broad based expansion strategy, which has 4 branches. Okay, expansion strategy has 4 branches. What are those? I will discuss that with you. Before which, I just want you to take a minute to run through what stability strategy has offered you, so that we can proceed further. Okay, that brings us to the end of the first strategy called the stability. Then now we will move on to the next one, which is called as expansion strategy. And as you see there, I've already marked and kept four branches for expansion. So as we go there, we will have to find out what those four branches are. And now it's a very critical discussion for an expansion strategy, because a lot of questions and lot of possibilities are there as to what they can come in the exam. So let us try and understand what expansion strategy has to do here. Before I move on, I would want to tell you the two words that you guys already know are the first two expansion strategies. First one is called as intensification. Intensification. And the next one is called as diversification, which we have already seen through in terms of our Igor and Soft's strategies. So there, we've gone through these two names, intensification and diversification. Then comes another strategy which is about expanding, is joining hands with other set of people called as M&A or mergers and acquisitions. And the fourth expansion strategy is termed as strategic alliance. What is it called as? Strategic alliance. Now, what is strategic alliance? What is mergers, acquisitions, and all we will discuss. But first two that we know very well, we have to go in detail with that. At least this part, there is no need for a rediscussion, because we've already discussed what intensification strategies are, which is about market penetration, which is existing to existing is market penetration. Existing product into a new market is market development, and you are introducing a new product into an existing market is called as product development. So all of these are part of intensification strategies, and I don't think we should make any fuss about those intensification strategies, because we know them very very clearly from the previous topic only. But now let's also write down here the list of diversification strategies, so that after you quickly read intensification, you can do diversification strategies. And for quite some time, I have been holding this term called as vertical integration. I said we will discuss. We've already seen it 4 or 5 times: forward and backward integration, vertical integration. Wherever you saw all that, now is the time for us to discuss that. First sort of diversification is vertical. Then we have horizontal. Then we have what is called as concentric. Also, the last one called as conglomerate. Now, the best part about M&A is in M&A also we have vertical mergers, horizontal mergers. In place of concentric, there is a terminology change called as co-generic, but the concept is same. And the fourth one is a conglomerate merger. So there, literally names have not even changed. Concept also does not change. But what is the main difference between doing diversification and M&A? I will discuss with you when we are in that particular stage of discussion. But right now, I want all of you to understand that the second corporate level strategy is an expansion strategy, of which you have the four branches as you see above: intensification, diversification, M&A, and strategic alliance. And I would want you to read the text very quickly of the three intensification strategies, because we already know them. So let us not waste much of a time in analyzing that. But before that, yeah, there is some introduction coming up, so we will also catch up on that as well. Growth or expansion strategy is implemented by redefining the businesses. So this definitely involves redefinition, which is quite an opposite of what you saw in point number 3 on your screen. You see stability does not involve any redefinition, but right now in growth there is absolutely a redefinition of the business by enlarging the scope of business and sustainability substantially increasing the investment in business. So 2 points which were on the opposite side in stability strategy, it said that does not need any fresh investment, the fifth point. And third point says does not involve redefinition. which is a totally opposite in expansion or a growth strategy. It is often characterized by significant reformulation of goals and directions, taking new major initiatives and moves which involve investments, exploration. An onslaught means going into or taking a chance into. Making an onslaught into is taking a chance into new markets, new products, new technology, or maybe even taking innovative decisions and action programs and so on. It's a very risky strategy, expansion, because when you try to follow expansion strategy, it means you're putting more money into business. If expansion works, nothing like that. But what if it does not work? That could also prove to be a challenge, right? Expansion includes diversifying, acquiring, and merging businesses. So we already know those four branches, nothing to worry. And you can see there characteristics of growth or expansion strategies are total opposite of what you saw in the previous page. I am not telling that, they only told. So start off. Expansion involves redefinition, underline. Expansion strategy involves a redefinition of business. Expansion is totally an opposite of stability strategy. In stability, rewards are limited, while in expansion they are very very high. Obviously stability will get incremental improvement slowly, step by step, and who wants that? But here it's totally an opposite. You are going to receive something huge. Expansion strategy is the opposite of stability strategy, and in stability strategy rewards are limited, while in expansion strategy they are very very high. Expansion strategy leads to business growth. Expansion strategy leads to what? Business growth. But does it require fresh investments also? No doubt. This is by a renewal of the firm through fresh investments and introducing new businesses or products is only facilitated by expansion strategy. You can't follow stability strategy and introduce new products. You can only maintain your existing products through stability strategy. But when you want to launch something new or grow big, then you definitely have to go for fresh investments with an expansion strategy. It's quite different from everything that we normally do. That's why it's called versatile. Now normally you use the word versatile for movie actors when they do multiple roles and they're not doing a conventional same role. Now if somebody becomes a cop in one movie, they're a police character only. In every movie they are the cop. So that's the regular style. But we have so many movie actors who keep trying new characters, and when you see them doing new roles, then we will call them very versatile actor. Sometimes they become this, sometimes they become that. So versatility means what? Continuously and constantly bringing that amount of change. Expansion is that sort of a versatile strategy. Expansion is a highly versatile strategy which offers several permutations and combinations for growth. Several permutations and combinations for growth. An expansion strategy holds within itself two major routes, and I hope you guys know both those routes. One, intensification. Two, diversification. Both of them are growth strategies, no doubt. The way, the difference is in the way the firm actually wants to pursue the growth. You want to go new to new completely, then it will be diversification. But if you want to do anything, keeping one existing and one new or both existing, then it is called as intensification. Like you saw in stability, some reasons to do. Here also, some of the major reasons as to why you should do the expansion strategy is it is sometimes compulsory. It becomes imperative, means compulsory. The word imperative suggests compulsory. Okay. Please underline the word imperative. If you want to write it down there, please do write down. Imperative means compulsory. It may become imperative when environment demands increase in pace. No, sir. Even when environment demands pace, I will still run slowly. Then you will not be there only in the race. Correct? So you have to make those changes. And sometimes strategists may feel more satisfied. Strategists what? Will feel more satisfied when the prospects of growth from expansion, and CEOs or chief executives may take pride in presiding over. Yes, under my leadership, I would like to definitely show some growth in this organization. That's what CEOs would obviously want to do. And not only that, if at the right moment you do expansion and it works out for you, you will end up capturing more market share, and expansion may lead to greater control over the market when compared to the competitors. Vis-a-vis the competitors means in comparison to competitors. And advantages from experience curve. Do you remember experience curve? Now you understand why we read all those concepts in the second chapter. SBU, experience curve, product life cycle. Three very important concepts. They will keep coming in so many contexts. Okay, not just only for portfolio analysis. SBU, experience curve, and PLC, they will come in so many places because you are going through a part of that life cycle. No, so whenever you make a strategy, you will always keep in line the PLC in mind. In which stage we are in? At this stage, is the strategy correct? And who is an SBU? Is this an SBU? Should we apply this strategy to that? And how experience is adding up, a learning curve or experience curve will try to bring down the per unit cost. So like this, lot of points are there. And advantages of the experience curve and scale of operations, which is nothing but economies of scale, may also accrue when you go for a expansion strategy. Now I don't want you to break your head so much because I've already shown you this clearly. Expansion through intensification is these three words that you know: market penetration, market development, and product development. While diversification goes by vertical, which is having two things, forward and backward. I will explain you that in detail now. Then we have horizontal, concentric, and conglomerate. I'm going to explain you all four of these diversification theories now. And the same four words are used for merger. But what is the difference between this and that? We will see. And then we have a small concept called as strategic alliance, probably which we will discuss in our next session only. For now, all I want you to do is, without my involvement, you can comfortably read the intensification box because it's quite a repetition from what was given in ANSOF. So I want you to take a clear look on what is there on the screen for you to figure out those three. But before that, some intro paras there. I will help you with that. Diversification, okay, non new aspect, you know, right? New to new from the ANSOF matrix. That is what is diversification. Now, expansion through diversification. Diversification is defined as entry into new products or new product lines, new services, new markets, whatever, but they involve substantially different skills, technology, and knowledge. From whatever you're doing now, it requires substantially a different aspect for you to do what is called as diversification. For some firms, diversification is a means of utilizing their existing facilities. Concentrate on this line because I'm going to relate this line to a topic in a very short time. So diversification means utilization of existing facilities and capabilities. Utilizing what? Existing facilities and capabilities in a more effective and efficient manner. Are you doing something new? No. Are you bringing any new resources? No. Using the existing resources only in a more effective and efficient manner, that itself will help you, increase your production, decrease your cost. So much of innovation can happen. So some people thinking of diversification may also think that. Another reason for diversification lies in its synergistic advantage. See, all human beings, we have something called as energy. Energy means not what we get when we drink boost, not that energy. Generally we carry an aura, right? Like what we are as a personality, who we are. If I find somebody as interesting as myself, who can kind of strike a conversation with me, and that is exactly why each one of us have somebody like that who, in the current ways, we can call them as, sir, we are in the same sync. That's what generally many people use. We sync up so much, sir. Like whatever I talk, the other person understand, and the other person talks, we understand. Now this, I'm not telling if it's the, if it's only necessarily need not be people in relationship. It could be anybody. When you strike a chord, it could be a family relation. It could be any other relation outside the family. Anything. Okay. So basically, what we say, like, okay, I enjoy speaking to them, or I find it good speaking to them. Why? Because you kind of find that some wavelength match. All these are words that we use, right? We are in good sync, we have a same wavelength. All of these are very crude ways of explaining what is called as synergy. Synergy is a term that is derived from, compressing a word called synchronized energy. So I have energy and the other person also has energy. When we both work together on a particular aspect, and that is what is called as synergy. Or when it brings to business, synergical gains. Now I hope all of you have done mergers acquisitions chapter, will know what this is, or if you are about to do it in future, then you will know it there. Bottom line, X Limited does 50 crore business, Y Limited does 50 crore business. When they come together, they won't do 100 crore business, they will do slightly more than that. Let's say 110 crore business. So what is this extra 10 crore called as? The extra 10 crores are called as synergistic gains or synergistic advantage of X and Y coming together. Otherwise, X individually can strike 50, Y individually can strike 50. Then when they combine, they should strike only 100. No? How did they make it 110? So that extra 10 is the gains that accrue by working together or coming together, which is called synergistic advantage. I hope everybody got that point. Another reason for diversification lies in synergistic advantage. It may be possible to improve the sales and the profit of existing products by adding suitably related or new products because of the linkages in the technology and in the markets. What are those linkages? How one is connected to the other? Very shortly we are going to discuss. But before that, all I want you guys to do is do a quick exercise of reading what is there on the screen quickly. I'm going to be right with you here. So I want you to quickly do this. Intensification part, just cross check and underline what you read in ants of product growth matrix. Is it the same? Market penetration, market development, and product development. Come on. If you guys can take a minute to do that and finish intensification, then we can safely proceed with diversification. Come on, I'm right here. Market penetration, market development, and product development. So, what do you see in the first box? Please underline those two words. Penetration is what? The most common expansion strategy. It is the most common expansion strategy and which pretty much concentrates on the current business. Resources are directed towards a profitable growth of the existing product. Profitable growth of existing product in existing market. If you are marketing products into new areas, geographical areas and new areas, through different channels, different distribution, or by even by changing the advertising content. I told you you're targeting a new market or a new segment, that is called as market development. What is it? Going into new market with an existing product. And product development involves substantial modification of the existing products, that you are bringing a new product into the existing market through your established customer channels, whatever are there. So you're not changing the market there, you're bringing a new product. Nothing different from what is Ansoff product growth matrix. And I hope you are easily able to catch up that intensification part. So what I want you to do is to quickly go through that so that we can move on to diversification. Now we are seeing diversification there. In diversification, okay, though the order is given in a different way, I want you guys to concentrate on something that I'm going to show you. So first we will do what the other ones are, and then we will come back because there is a flow that we can catch up here. So we will go with vertical, horizontal, concentric and conglomerate as you are seeing there. So let me take you through to some example here which I want you to understand. So we are going to now discuss vertical, and as we normally do, we will finish the discussion and then go back. That will be way more interesting. Okay, now in vertical diversification, what I want you to understand is there are two types: forward integration and backward integration. What is vertical diversification? If somebody asks you what exactly constitutes to vertical diversification, you can say moving up or down. So either you go one step above you up or one step down. Okay, moving up or down where? In the product or process chain. In the product or process chain. Sir, now I don't know what is this product or process chain. That is why I am here to explain you several things which are not there. Now let's catch up here. First thing, first and foremost thing, to produce a product, what do you need? Raw material, correct? Then after raw material, the next step is manufacturing. Then the next step is distribution. And the last step is selling it in retail, correct? Now watch very carefully. This is where the example is involved in. This is where the entire concept is involved. So, company A is already doing manufacturing. Okay, company is not, it does not deliver any raw material, it only does manufacturing. So, it means it is right now procuring raw material from elsewhere. It is not doing any distribution, neither it is doing any retail. Okay, now company A decides to also do raw material for their own self. So I'll tell you what, company A was manufacturing sugar. Now for sugar manufacture, obviously they need sugar cane. So company A used to procure sugar cane from somebody else. But now they thought, no, let us grow on our own. So this is what company A did. They started holding more parts of this product or process chain. So this is the entire chain. No, they said, why should we depend on an outside supplier? Why should we depend on an outside supplier? Let me be my own supplier. And they entered there. So that is raw material. And they'll continue to do the manufacturing. Okay. And these two, they are not doing. Now, one more scenario. Company A is not doing the raw material. What company A is doing is manufacturing. But then they thought, why should I let it distribute through some other intermediaries? Why not I only have a distribution channel and let me distribute now? So I'm creating my own customers and then I'm not doing retail. Now, from this example, what you should understand is that if I am owning more parts of the supply chain, if I am owning more parts, while I was owning only manufacturing here, in this example, I entered one step back. So, did I move out of this product or process chain? No, either I went up or I went down, but I didn't move out of the process. So, moving up or down in the same product or process chain, but either backward, or in this example, if you see, I was already doing this and I came here. So, this is what is called as forward integration, and this is what is called as backward integration. Both forward and backward are part of vertical integration or vertical diversification only. So in vertical diversification, what's happening? Either you move forward in the process chain or either you move backward in the process chain. But the idea is to own more parts of that value chain. To own more parts of that value chain. This is the story. In horizontal, you know what is happening? In horizontal, you are a company who is taking over, right? In horizontal, we are taking over what? Competitors products. That means people who are competing at the same level. Raw material to raw material, manufacturing to manufacturing. So if company A is there, then company B will be involved in horizontal. So you go and join hands with that. Okay, competitors products. So horizontal diversification involves taking over of competitors products, or maybe even complementary products or byproducts. So, for example, let's say company A is producing smartphones, company B is there which is producing earphones, accessories. Okay, so these two coming together. Now, a smartphone and earphones are complementary products, right? So they two coming together will be called as a horizontal diversification. They are at the same level, okay, and at the same level when it happens, that is called horizontal diversification. So this is vertical, the next one is horizontal diversification. Now don't worry, when we read it we can redo this entire story, but for now I just want you to understand how this entire thing is spanning up. So vertical, horizontal, the next one is what? Concentric, right? So vertical and horizontal, I hope all of you are clear. Two types, forward, backward. Now then moving from here, I'll tell you what concentric diversification is. Concentric diversification is, so you are trying to use your existing facilities of a business. Right now, whatever facilities you are having, you are spin off from the existing business. It's a spin-off from the existing business. Like for example, I'll tell you, I'm using my current facilities and trying to create a new product which is somewhat related to my existing product. I'll tell you example. So I'm right now manufacturing cars. I'm a car manufacturer using automobile technology only. So using my same plant, same engineers, same setup, I'm now starting bikes also. Sir, car and bike are two different products. No, yes, car and bike are two different products, but are they related to the same automobile technology? The process, the by way the engine runs. Okay, so in concentric diversification or in concentric diversification's actual idea is to have the new product which is a spin-off from the existing facilities. You didn't do anything new. Using the same facilities, you created the new product. The new product, which is a spin-off from the existing product, is related to the existing product. But sir, car and bike, they're not related directly. Yes, they're definitely different product, but they're related to the existing product through three aspects. What are the three aspects? Process, technology, and marketing. Process, technology, and marketing. So if some business are connected through process, technology, or marketing, after you've made an entry there, that is only called as a concentric diversification. Then the last sort of diversification is called conglomerate diversification, where between the new product and existing product, there is no linkage exists between what and what, between the new product and the existing product. Let's say the Tata Group, Reliance Group, Birla Group, everybody has been doing conglomerate diversifications into various areas. Like for example, Tata is into Tata Steel, then they jumped into Tata Motors, no connection. From Tata Motors they went into Tata Consultancy Services, making softwares, no connection. So absolutely, where there are disjoint, new product to existing product, no linkage, you can remember another word they called as disjoint products. That is called a conglomerate diversification. So this is the story of vertical and horizontal. Then this is the story of concentric and conglomerate. So all four types of diversification. So now vertical, horizontal, and concentric, you have the new product or the new diversified aspect. New product is related. New product is what? Related to existing product, correct? In the first case, they are directly related because they are in the same product or process chain. That is in vertical. They are directly related because they are in the same product or process chain. In horizontal, they are related. Either they are complementary products or byproducts, something like that, but they are related. In concentric, sir, they are two different products. Agreed, they are two different products, but there also they are related, not directly. So in concentric, they are related in a loop-like manner. When I say loop-like manner, it's a very simple thing to explain. Like there is no direct connection. There is a connection in the form of a loop-like manner through what? process, technology, or marketing. These three factors. Okay, so let us revisit all these parts after now reading the text here. So I hope all these points are absolutely clear to you. We will now go ahead and read one by one. So I will not start with concentric, I will start with vertical because that's how it's easy to understand. Check vertical integration. Now in vertical integration, what's happening? Firms opt to engage. Firms opt to engage in businesses that are related. I want you to underline that, related to the existing business of the firm. And you should remember one thing, the firm remains vertically within the same process. That's all. Either you move up to become your own supplier or you move down to have more parts of value chain under your control. That's all. But you will either move up or down. You're not deviating to or jumping to another product. This is vertical diversification. Guys, concentrate. Very, very important. Lot of questions have come in the exam. So I need you to have your attention to the maximum. Firms opt to engage in business that are related to the existing business of the firm. They move in vertically in the same process, but only in the sequence which is forward or backward in the chain, and enter specific product or process steps with the intention of making them into new businesses for the firm. Put a star point is this. Which one? The firm does not jump outside the vertically linked product or process chain. Now I think I've very clearly shown you that as part of my example. Correct? I don't want to go back there for a minute. I want you to concentrate on both these forward and backward because they have very similar example here. So just give ourselves a minute. Backward integration is going one step behind. So it's a step towards creating your own supply effectively. Why should I depend on outside suppliers? Now I've been depending on so many farmers for my sugarcane supply. In my example, I told you you're a sugar manufacturer. And then several farmers are, delaying that or not giving it on time or giving some rotten sugarcane. So much drama is happening. Why should I depend on them? Why not open and create my own supply? It's going one step back in the chain is called backward integration by entering the business of input providers. Very easy, no? Till now, whoever has been providing me the input, now I only start that business on my own using my extra resources. Start that. Backward integration. Strategy employed to expand profits and gain greater control over production. Obviously, why should I depend on others? I will only have that and have greater control over production of a product whereby a company will purchase or build a business that will increase its own supply capability or bring down the cost of production. It's a very clear thing. No, when we own more parts of the supply chain, either upside or downside, total cost of production will definitely come down. Because if we are our own supplier, we will not add all the profit margin and other thing. We will give it at cost to cost, right? So whatever cost it goes into making the raw material, that will be the input cost for manufacturing also. So that way we are saving on what profits we were paying to the supplier, because supplier will not give you at cost. Supplier will give at a cost plus whatever his margin is, but now you became your own supplier. Same way earlier, whatever commission and other thing distributors used to charge, but if you go in a forward integration and do it for your own self, you don't have to pay all that to you. So vertical integration, the main idea is to bring down the overall cost of production whereby a significant advantage can be gained. A large supermarket chain considers to purchase a number of farms. Simply, I told you sugarcane. Here they are telling you supermarket will buy large number of farms so that whatever vegetables are produced there, directly from there, bring it here and sell in the supermarket instead of depending on farmers. Forward integration. Moving forward in the value chain and entering businesses or business lines that use our existing products. Organizations enter into businesses of distribution channels. Till now, somebody was manufacturing coffee beans. He thought, why should I manufacture these coffee beans and supply to so many coffee shops? Why not I only go and open a coffee cafe? Cool, do that. Sir, but will it work out? Here the idea is not to find out whether it works out or not. You want to own more parts of supply chain. Sir, can I own all four parts of supply chain? Choice is yours. Time and patience is what we need. Okay, I'll for a minute come back to this example after doing horizontal also, because what we orally discussed only is there in this example. But let me take you back to the previous page. Horizontal diversification. What about horizontal diversification? In horizontal diversification, you are going to acquire one or more of similar businesses operating at the same stage. Operating at the same stage of production or marketing chain, that is either going into complementary products, byproducts, or taking over the competitors' products. So the definition of vertical integration is clear with forward and backward. Now, horizontal diversification is clear. Don't worry, related, unrelated, we will see the difference. Now, moving on to the third one I told you is concentric. The concentric diversification, the new business is linked to the existing business through three words: PTM, process, technology, or marketing. Are you bringing some new facilities and putting up? No. Sir, where are you getting the facilities from? The new product is a spin off, means bringing it out of the existing facilities or production process, which means that concentric diversification too, we are looking it for synergistic benefits, which I explained you some time back. In concentric diversification, also, what are we expecting? To get some synergistic benefits. Last one is called conglomerate diversification, where no such linkage exists. The new product is completely disjointed from the existing product or business in every way, and it's totally an unrelated diversification. You have no experience, it's not connected to your current portfolio. Why are you going into that new business? Maybe you want some new kick in life. We don't know why are you going there. Maybe it's your interest or whatsoever be the reason, you are going there for a change. You are not doing something that is connected to your existing business. There is no common thread. Underline, no common thread at all with the firm's present position. Sir, same thing you explained. No, why did you write it? I wanted to make a point to do it twice. That's why I first wrote it on screen, then I made you read this. What I wrote on screen is no different from what is it given here, no? So I wanted to do the same topic twice, right in front of you, because it's that important. Many times MCQs can crop up, short answer can crop up, so all those things are there. Now tell me, of these, I hope you should have understood what are related diversifications also. Vertical, horizontal, and concentric. In concentric, direct relation is not there, but they are related, no, through process technology. Sir, where is your nose? I'm not showing it like this. In concentric, if they ask you where is your nose, it's like from here. Some loop like manner, but connection is there, no? That is what we are trying to establish. Now, the two boxes that we missed out here are nothing but reading about the differences in related and unrelated diversification. Is it all coming up in one screen? Yeah, absolutely. So, just quickly see there. Related diversification, exchange of share assets or competencies by exploiting. You're using the same brand name, same marketing skills, sales and distribution capabilities, manufacturing, R&D, and economies of scale. This will accrue. Which one? All these points what you saw there in the related diversification box will accrue if you are doing vertical, horizontal, and concentric. But if you are doing conglomerate, that is unrelated diversification, what are you doing? You are investing into a new product portfolio, employment of absolutely new technologies, focus on multiple products, because right now current product and that product are not related at all. Reduce the risk. What's the best thing here? What are you doing? Reduce the risk. How? Because your if your current product suddenly fails in future, maybe this new product will help. That is also there, no? How long will, see, Reliance today is entering into so many retail aspects, like not just telecommunication in Geo, but other retail aspects also. Why? Their petroleum business is not doing so well. Nothing like that. Somewhere when something ends, now Tata is also there, a group. They're doing so many businesses. Why? Is one of their businesses not profitable? Many of their businesses are profitable. It's not like we don't want to be there, but when we own more parts of a value chain, Like Mahindra and Mahindra was there, which was into totally manufacturing the vehicles. Okay, then they made it Tech Mahindra. Then M&M Financials, Mahindra Holidays and Resorts. Why? Mr. Anand Mahindra doesn't have any work. Not like that. When you have conglomerate businesses, so sometimes even when season is down for one particular business, or because see these are all called cyclical businesses. When you say when you say these are cyclical, it means sometimes some businesses may not hold good. It's not like 365 days there is festival, correct? So some businesses are down for 1 year, 2 years, 3 years, and that time when those are down, these will help, and when these are down, other ones will help. That's why they have multiple products in their portfolio. Reduce the risk of operating by operating multiple products. And best thing is, if you own many products like this in your portfolio, if you own many products like this in your portfolio, you can defend over somebody taking over you. If you have only one product in your portfolio, now somebody like Reliance or Tata, some giant will come and they will offer me the tea business is there, chalo, 50 crores, and I will suddenly open my mouth at 50 crores are. For them, that's a small thing. But now, can I go this and do counter offer to them? Now, can we go and say Tata Group? Tell what is the valuation Tata Group? Tell I will buy. Who will tell that? Not possible, because they are defended themselves. Now nobody can take over such groups. So defend against takeover bids means when you are a conglomerate business, when you own multiple parts of business, that is many products in your portfolio, it becomes difficult for others to take you over. Now imagine taking over Reliance, or imagine taking over Tata Group or Birla Group. It's not possible that easily, because they have diversified so much. How much will you take? Now the same thing what happened with future retail. I hope you guys are aware of the future retail example that I'm going to tell you, because it was recently in the news so much. Future retail is a brand that has Big Bazaar. Okay, at least now I hope you can understand that. So Big Bazaar, Brand Factory, there are many things which are part of the future retail. Now that entire retail group, though they have a bit of diversification, our Reliance Group took it over completely. But can somebody take over Reliance like that? So when you are a conglomerate, it's something that acts as an armor for you. You can stop all the takeover bids. Nobody will come and throw you offers like this and say how much. Now see what happened with Coffee Day. Okay, Tata Consumer Products, that's a company which is a listed company. They went and they said, how many machines are there? Okay, bad story. Your CEO died. 600 machines. Okay, we're taking over. Because Cafe Coffee Day is only one unit. Taking them over is easy. But conglomerates can defend against the takeover bids, and conglomerates will, these kind of businesses, they will always have focus from the top management, provide executive interest. So you can focus on that. So those are the four pieces of very important aspects that in the organization. Diversification, it does not happen daily. Okay, diversifications don't happen daily, but when they happen at a scale like this. Now one last thing to close out this topic and our session is this slighter discussion between vertical integration and concentric. They gave a small box here which asks you, how does it differ? Obviously there is a difference, which I again orally explained to you just a couple of minutes back. The nature of linkage between the new product to the existing ones are absolutely different. Yes or no? In vertical diversification, you're not moving out. It's either up or down, but in the same product or process chain. You're not even changing the product. But in concentric, the product changes. It is linked to the existing product in a loop like manner through process, technology, or marketing, not directly. That's all. In vertically integrated diversification, the new product falls within the current product or process chain. In concentric diversification, there is a departure from vertical linkage. They both are not vertically linked. Then how are they linked? The new product is connected in a loop like manner at one or more product points through process, technology, or marketing. Those three words are important: process, technology, or marketing. That's how they are connected in a concentric diversification. So to end this particular session, now I'm confidently able to show you this on screen. To close out, we can see there very clearly that company A was doing manufacturing, and if they move on to do even the which one distribution part, then company A is said to be doing the forward integration. But if company B, from company B's perspective, you see companies B's perspective, they were initially doing distribution, that is where the tick mark is, right? And they thought they will start doing manufacturing, then the arrow mark goes to the backward direction, so that's backward integration. So those are the two there, forward and backward, that is right. So company A willing to do this will be forward integration. Company B, which was initially doing this, now wanting to do manufacturing, will be called backward integration. In fact, you can have this also anywhere moving up or down, but in the same product or process chain. But company C taking over company's D's product will be called as horizontal integration. So that's where we sum up this particular discussion of the expansion strategy. Now we all know that in expansion strategy we have four branches, and what are those four branches? So let me quickly take you back there to the expansion strategy so that we can quickly discuss that and close. Right there we are. So intensification, diversification, M&A, strategic alliance, four branches in expansion. But now we have already seen what is called as intensification and diversification. We will obviously see M&A and strategic alliance in the next session. So to tell you where we stand finally before I close out, we are now doing phase 3, which is on crafting the strategy. And as part of crafting strategy, the first set of strategies that we are crafting are the corporate level. Totally four strategies are there in corporate level. The first one being stability. Second one is expansion. Under expansion, we have four, of which we have covered these two for now. And in the next session, we will go ahead and cover what is called as mergers, acquisitions, and a strategic alliance, which will help us wrap strategic expansion. Then we'll go to the third branch, which is called retrenchment, and a short note is there on combination, which we will see in our next session.